Hi, I'm Raoul, and welcome to my show, The Journeyman. The Journeyman takes us all on that journey to the nexus of understanding of macro, crypto, and the exponential age of technology. In recent weeks, I've covered a lot of ground in crypto, and I want to flip it up right now and cover macro. You see, I've been doing macro for 34 years. It's my lens on the world. It's this 3D incredible jigsaw puzzle that you're trying to solve at any time. And it's complex because the secular trends, the cyclical trends, it's how it all fits together. There's time horizons, all of that kind of stuff of constructing a macro view and then a macro portfolio. It's not easy. It takes time to learn. Now, obviously, at Real Vision, we've been teaching that, the Real Vision Academy, which is part of Real Vision Plus, which if you guys haven't checked out, it's incredible because I'm in there plus a whole bunch of other people helping you build out your understanding of how to invest. So the Academy is great for that. Also, the macro investing tool by Julian Bittle and myself keeps you on top of the business cycle, where we are, what matters, where liquidity is going, the things that really count, and simplifies it down into what assets should you be buying. It's not a trading system per se. The macro investing tool is really your hack into putting probability in your favor. It's Julian Bittle distilling down what it really takes to allocate capital in portfolios. And allocation capital in portfolios using a macro view is one of the things that I love. It's what brought me to crypto. It's what brought me into technology investing. And it's created some of the best calls of my entire career. And so I love to talk macro with people. And this week, I'm really privileged because I've got Rick Rieder from BlackRock. Rick is one of the largest managers in the world, very famous macro player. He's been around as long as I have. We've got war stories to talk about, and we're going to get to learn a lot from him. He really is a fabulous person and a great investor. So let's listen in to myself and Rick Rieder. Join me, Raoul, as I go on a journey of discovery through the macro, crypto, and exponential age landscapes. In The Journeyman, I talk to the smartest people in the world so we can all become smarter together. Rick, fantastic to have you on Real Vision.
Thanks for having me.
Look, I'm really excited. There's a lot we're going to talk about because we've both been in macro markets for 30 odd years now, showing our age. As ever, first, tell people what you do. Most people know who you are. And then I just want to go back in time and get some of your story. But what do you do now? Because you have quite an impressive job.
I don't know. I'm C.I.O. for our global fixed income at BlackRock. And I also run our global allocation business, which is more of an equity-oriented portfolio. Now I sit on a bunch of committees for the firm and, manage, I guess I'm 2.7 trillion in assets, which keeps me up most evenings. I enjoy my Saturdays.
Yeah, exactly. That is not, that's something I wouldn't be very happy doing, but there we go. So listen, how did you get into this business in the first place? Give me a story. I'd love to hear about that.
So it's kind of crazy. Both my parents were entrepreneurs, crazy hard workers as I am. And they're, I never really knew finance. I didn't have a background. My parents weren't really in a finance. And so I didn't follow the normal path. In fact, I went to a liberal arts college for a couple of years and I did very poorly. And because it didn't make any sense, I didn't understand it. Sociology, psychology, I literally couldn't understand it. But I guess because I had a more of an entrepreneurial business heritage from my parents, I transferred to Emory University and all of a sudden these business classes made sense to me. Finance made sense. It seemed logical. It seemed like I could put things in boxes. And so I did that. I did pretty well there and ended up I worked for a bank for a couple of years doing financial analysis. And then I called SunTrust at the time, now Truist. And then I went back to, I couldn't figure out apparently business education once. So I went to Wharton to do it again. And then I had this crazy lucky situation. I mean, you talk about things in your life that never would have. I was going to go work for a great firm, a big U.S. bank to do financial analysis, peer, sort of strategic analysis on the finance side. And anyway, somebody I was at E.F. Hutton. So I don't think anybody remember. Maybe you and I remember that
I
firm. But
remember E.F. Hutton.
yeah. So they said to me, this woman decided, she said, why don't you try trading? I had accepted the job somewhere else. And I told all this to my kid, like, once you accept, you cannot go back. I know why the woman was persuasive, and I liked sports. Earlier in my career, I liked, or I guess when I was in school, I liked to gamble, and I liked, so I said, she said to me, and she said, you've always done financial analysis, strategic stuff, and looking at numbers, and this fits in terms of how you think about the world. You're competitive, so anyway, I did it, and like I think I've told the story before. My dad said, trading's not a career; it's a hobby. And anyway, 36 years later, I'm still trading a lot.
I'd never forget first going into the trading floor, sitting at a desk thinking, what the hell is all of this? I mean, it's just, all of the prices moving on the screen, trying to figure out what everybody's talking about and why they're talking about it.
So can I say one thing? I don't know when people are going to watch this, but today, when a person I'm working with for over 30 years, so the payroll report comes out, and your blood pressure, at 829.5, my blood pressure shoots higher. And I said to him, how many more times are we going to do this? But then, he broke me back. He said, how much fun is this? And I said, it is. I guess it is. And it's similar to like if you're playing a sport, like, you want to have the ball at the end of the game. But I don't know. I mean, it's like, I don't know if you're 36 years, 12 months a year by the way, you get the CPI report, the FOMC meeting, and, but anyway, I like it. I think I like a lot of people, I really like the adrenaline rush, and I like that, you get it, I like, the gratification of, hopefully more times than not always, but, hopefully 60% or more of the time, you do all your work and you prepare for it, and hopefully your data helps you analyze it. But I'll tell you, it's still, I've been doing this for such a long time. When you're wrong, like it is. I mean, it's brutal. I mean, you go back, like, what do I do? Like, am I not, like, maybe I should, my brother became a doctor. Like, what was I thinking? That was the path. And, anyway, it makes it fun, but boy, you got to have a lot of humility, I'll tell you.
I know. And the good times never make up for the bad times. You remember the losses. You remember when you got it wrong, or even when you thought you got it right. It just never makes up for it. Like, the reward system is really perverse. It becomes about pain avoidance as opposed to everything else.
Well, I think, by the way, I can't remember anybody's name. And I have this terrible thing. Like, I go to a cocktail party, my wife says, yeah, that's your brother. And I'm like, I know it's not my brother. I'm like, I don't remember their name. But if you tell me, like, every position I lost money, like, I can tell you that, like, on a bond, I can tell you the coupon, the maturity, when I did, why I lost the money. It puts this unbelievable imprint on you that, and like you say, they get the wins. I don't know. They sort of, they don't put that sort of imprint. And I've had, quite frankly, some learning experiences where, like, early in my career, like, I took a really big loss on something that I thought it was right, and I kept buying it. And by the way, I was ultimately right, but it didn't really matter because the market didn't.
That's the worst one. That's the worst. Yeah. When you are right, but your timing's wrong.
And by the way, when I got out, it was proven right, which is even more painful.
So when you start, E.F. Hutton, what were you trading when you first started?
So I was, I was just in the training program. It was their first and only training, but they never had another one. It was, and I was only there for a few months. I think the training program became playing Liar's Poker. I don't remember Liar's Poker, but
of course,
like, we didn't have it. After the crash, it was 87, and after the crash, like, all we did was sat around and played Liar's Poker. We had no job. And anyway, I was actually going to trade agents. They were going to take me out of the training program to trade agency mortgages, and that was going to be my role. And then Lehman Brothers bought E.F. Hutton, and anyway, I met a group of people that I really, really liked, and in corporate bonds. And instead of doing mortgages, I shifted and did corporate bonds. So I started doing that for a while. Traded everything from Yankee bonds, crossover, high yield, high grade bonds, emerging market debt. So I traded a lot of aviation debt, which was fun. But yeah, I know I started trading corporate bonds. And
what year was that? 1990?
No, so it was trading from 80. I really started 88, summer of 88. And then, and then I got different books to trade. And then, and then I ended up running the credit desk at Lehman.
I mean, but what a fantastic time to be in the bond market, right?
It was definitely a lucky time. And by the way, you talk about like things in your life that happened. The guy that I swear the day I was being placed in, they place you out of these training programs, somebody quit, and then nobody had quit in that area in 7 years. And anyway, so I called them and I said, wait, somebody, there's a spot open. And they gave me that spot. And like you say, by the way, how the markets trade now versus then, you think about how different they are and how I remember I was like the young kid on the desk, and I remember I built this Excel. It probably wasn't even Excel at the time. I built this spreadsheet, probably Lotus 1, 2, 3, and we ran all our risk systems. And I'm like, who is this guy with the risk systems? And then, by the way, it was a funny thing because all the traders started using them. But if anybody hit the wrong cell, it blew up the whole program, and I'd have to like work all night to fix the program. It was like you talk about being like cut and pasted, and so. But it was a fun time. But you think about how everything traded. Like there was no risk systems. Like we used to get these printouts of like you own this bond. And then, it's a little different today when we're using AI implementation on our, data assimilation. It's a little different.
So where were you in 1994 when the bond market blew up? And how did you cope with that? Because that was a hell of a time.
It was. So I was trading, I'm trying to think, I was trading corporate bonds. At the time, I was trading crossovers. So anything that was sort of between high grade, investor grade, and high yield, which was a pretty vibrant space because anything that was on the way up or way down tended to be pretty volatile. So I was trading that stuff. And it was a bit before I had taken on emerging markets, which, later on became spicy to say the least. But I was doing it back then. And by the way, it's funny. I always think about this, that, there was a crisis. You go back in time, like in 1994, there was savings loan one in 90. In 94, then 98, then 02. And it's like, I started to think about maybe I should do nothing but like take the year off when it was the fourth year of one of these cycles. But it was incredible how rhythmic that was until, by the way, it should have happened again in 06, but the Fed kept policy too easy. And then it blew up in 08. And I always say like the veracity of what happened in 08 is because you got to let them, it's, whether it's supposed to be every 4 years or not, there's a rhythm. There is a natural rhythm. Like people build confidence, and ba-boom. And then I really believe that it extended later, and it was more devastating because of that.
Hey everyone, listen, if you want to unfuck your future, let me help you. Follow this channel, subscribe, click the notifications, and you'll get everything as soon as it comes out. See you there. Yeah, I'll get on to the world past 2008, because I think it changed again after that. But I just want to get, so you survived the 1994 blow up, then 98 was another massive one. I was at Goldman by then, and that was a big deal. I mean, Russia, and you were trading emerging markets then as well, weren't you?
Yes, sir. In fact, the firm gave me, I took over emerging markets. It was actually a bunch of what Lehman had a really hard time with going back in 98. And anyway, I think they said, give that dope, the emerging markets business to we had a tough time. I ended up taking it over and tried to dull our risk and change how we were running our emerging markets business. And thankfully I had a couple of really, really good people who did it. I'm just going to help me do it. Actually, they did it. And, but boy, oh boy, it was Russia, the Asian crisis. And it was, watching, Russian debt trade down to pennies. And by the way, there were some, I always say there were some big exposures in the industry. And I always found it interesting when you would read earnings reports after that. And you'd have a number of institutions say, we took down our Russian exposure. And then I looked like it was a proactive risk management. And then I looked at it, it's like, actually the prices went down 60%. Like that's how you took it down. Like almost to the dollar. It's like we reduced our exposure and it was to the dollar, but the price went down. It's like, wow, that was proactive risk management. And boy, that was, you learn a lot and you learn a lot about EM at that time in politics.
I never forget, I was at Goldman at the time running the hedge fund sales business in equities and equity derivatives. And two things, obviously the Asian crisis, everybody was super active over that period. Everybody was blowing up. Gavin Davis was coming on. If you remember Gavin, he was the chief economist at the time. He
Yeah,
was
I did.
he was coming on the Squawk Box telling the whole floor that he thought that Russia may go to civil war. We're like, oh my God. And then
Wow.
long-term capital blows up in the middle of it, who's everybody's biggest client.
Oh my God. Yeah.
Half the banks are almost going to go under. What a time that was, right?
It was, I mean, it's unbelievable. By the way, I used to talk to, I had a couple of friends and people I talked with at long-term capital. Those people were brilliant.
I
They
know.
were the smartest people in the industry. What was it book when genius failed or something?
That's right.
They were really, really smart. I used to talk to them all the time. Their positions were just too darn big. And it, taught me a lot about that. I mean, I have to say, that particular situation taught me a lot about scaling. And you could be, for what we talked about earlier, you could be right, but the markets don't think you're right, and or some exogenous shock hits. Like you can't be that big relative to the markets, and they were smart people.
I never forget, I was on a stag weekend in Kilkenny in Ireland, and we were on a boat fishing, and all of the friends were in financial markets. And it was the usual question after a few beers. It was like, who's your biggest client? And everybody was long-term capital. And I started adding up the equity derivative books alone on the European side, and we were already at something like 12 billion, and long-term capital had 3 billion or whatever under management. Then a friend of mine was running fixed income trading at Deutsche Bank, a guy called Justin Excel, and Justin said, I think we've got 100 billion. And at that point, I was like, oh my God. I had to go back to the risk managers and say, we need to get out of long-term capital because we have got huge problems.
Oh yeah, no, it was that size. You think about that size now. I mean, it'd been back then, and the positions were sort of, because I was doing credit. They weren't involved in long-term credit, in credit, I should say.
No,
But they,
but everything dislocated because of them.
Exactly right. Exactly right. And you also realize, which also, manifests itself later in '08 and otherwise, you realize, I think about this today. Like you could be positioned right, but you got to think a lot about what everybody else has, because they can have, impact your assets pretty darn dramatically.
So where were you by 2008? Had you left?
I was at Lehman. No, I was, yeah. I actually left in May '08, which seemed prescient. I don't know how prescient it was. It certainly wasn't a forethought on my part that the industry would have, or Lehman certainly would have a tough go. But starting a credit hedge fund in May '08, right, is like if you saw the weather forecast and a tornado was about to come through and you decided it's time to play golf. It wasn't the most thoughtful. I just didn't think. I mean, quite frankly, part of why I left, much of why I left, was I thought this was going to be such an incredible opportunity. The volatility, the dispersion in credit markets, like this was a great time. Anyway, I literally didn't think it was going to be like that. But yeah, I left. So I would say I was at Lehman for for 21 years.
And then, so you set up your own fund?
I did. Yep. I set it called R3 Capital. I did. I ran it for a year. We had as you imagine, tough go in '08. We started to do really well in '09. But I said, that was by far the hardest period of my life. That was by far. I mean, nothing's ever come close to that.
What? To talk me through that. What was? I mean, it was obviously hard markets. But what was it like for you? Because you've started. This is your new ambition. You start a new fund. It's like your new opportunity, and everything falls apart.
Yeah, and we were a big launch. I mean, we're over $4 billion in assets at the time, and now it's a big launch. And it was, I had a lot of people with me, and so you feel the stress of everybody on your shoulders. And Lehman was one of my prime brokers, and my assets got trapped at Lehman, and you didn't even know what assets you could sell or how to manage it. And all of a sudden, there's no liquidity in the markets, and credit was coming under pressure nobody had ever seen before. That it was brutally hard. I mean, it was just brutally hard. And then then we had to exit Lehman Brothers, and we had to get our assets out of Lehman Brothers, and it was brutal because it was a period of uncertainty, and it looked like we were going to be out of business, and it was hard. I mean, I'd like to say, like a lot of people, walking in every day, I forget there were 50 people or something. And, you feel like you got everybody's career on your shoulders. It was not a, and by the way, the huge part was everybody, the capital we had and people entrusting us. It was, I never want to go through that again. Anyway, by the way, it's had a big influence on how I manage risk today. And, the idea of how you diversify. I think a ton about contingent liquidity. I think a ton about how much cash, when I buy illiquid assets, how much cash do I have in the portfolio? But you talk about leaving an indelible mark on how you think about things.
Because what
Plus,
people,
learning about.
because
Go
people
ahead.
thought markets were the risk, but they weren't. It
Yeah.
was who had your assets, who was
Yes.
borrowing on top of the assets, whose
Yeah.
collateral was it in the end? All of these
Yeah.
things we never thought about before. We'd thought a
Yeah.
little bit about in 98 with long-term capital, but this was like there was nowhere to hide.
No, and I think one of the things that I think laymen don't, or laymen are not in this industry, don't really recognize is it's an incredibly intertwined industry with counterparties and borrowing from others and swap agreements, et cetera. And like when one entity go, particularly a large entity, like what it does and how it catapults the pressure on the rest of the industry. I mean, that one, think about all the firms in 2 or 3 days that were going to go out of business. I mean, it was extraordinary. I mean, it's because the industry tends to be this intertwined industry that, and nobody had ever seen that before.
It was really interesting. I was speaking to, I think it was the New York Fed sometime afterwards, maybe 2012 or 11. And I asked them the question that we were all asking at the time. It's like, why was that allowed to go bust, but AIG wasn't? And they said, simply, AIG bonds were leveraged 35 times collateral because there were AAAs, and Lehman never was.
Yeah.
And if we'd have let AIG go, the whole daisy chain of everything would have gone, which is what the ECB then told me in 2012. They're like, we could let Greece maybe, but if Spain had gone or Italy had gone, it was all finished.
Yeah, no, it's pretty incredible. And they made. So history will recount whether it was worth letting Lehman go, or were there ways to partner it or put capital in, and I don't know. But some of these things have become, just because the financial industry, the nature of gearing and how it works, and is can be stressful. I said years before that, I said, why does this industry trade? Shouldn't it trade at a higher multiple given how much M&A, what it creates in earnings, ROE? And then you realize, like, wow, it can. I know I get it. Like, I know I get it. Why you got to be like leverage can be pretty devastating.
So, when did you join BlackRock? And to talk me through your story.
May 09.
Oh, okay.
May 09. So and so things had settled down. My fund was doing really well, and we had a I would say one of the partners of my firm. We had a tough conversation because some people were like, we knew we could do this, or we thought we could do this, and things are going well, and this is what we wanted to do. And I thought at the time, and no one of us thought at the time, BlackRock actually, BlackRock was a fraction of the size and that it is today. And we thought, being in the center of finance versus being on the periphery of finance, like you had, if you had a time to do that and the chance to do that, like that would be an opportunity hard to give up. And also I will say, going through the stress we went through for the months prior, it thinking about, gosh, it was a big respected institution that's pretty close to the epicenter of finance. So we ended up doing it. And what I'm super proud of, a huge number of the people that came with me for more than 15 years. I actually think it's just hit 15 years, that are still with me and are still running a lot of businesses. And I'm super proud of what they've been able to do. So, yeah, like I say, it was, I think at the time we had a really, really good team. And it's nice to see a bunch of them doing well today.
Yeah. And also, really smart idea to go to BlackRock, because you get rid of a lot of those risks that you didn't want to manage.
Yeah. Yeah.
Which is counterparties and everything else, because you're within a much broader institution.
Yeah. I think one of the things I also learned is I really like investing. And, by the way, dealing with the lighting and the insurance and and all the other stuff, it's like, it's like, I like investing, and I like coming in the morning and, trying to figure out, where should the S&P 500 be versus the NASDAQ, or an individual, looking at individual companies and, figuring out, like, do we need to redo our reinsurance risk or our insurance risk. Like, not was my highlight.
No. So talk me through how you invest now, because now you've obviously got large teams behind you. You're now much more strategic in what you do. You run a number of funds, right? You've got
Yes, sir.
You've got the ETF.
Yeah.
Talk us through all of the kind of various parts you run, and then we'll start getting into the whole macro view, because that's how you think.
Yeah, no, it's a huge honor. I run. So we just started this ETF that's grown pretty big. It's called Bank. It's called BlackRock Flexible Income. So it's just given people an ETF that we diversify the income as opposed to just a straight high yield fund. We do securitized, we do investment grade mortgages, and parts of EM. So it's just giving them yield, and we manage, try and keep the yield up with a lower volatility than just buying a singular asset. And so that's a neat fund. I run a strategic income fund. That's a big unconstrained fixed income, allows us to go anywhere in fixed income. I can use some equities, 15% equities, but mostly fixed income, tactical around fixed income. So very unconstrained, I can move my duration around. I can run -2 years to 7 years. So I've got a huge swath, and I can run some shorts. It's not a long short, but I can run up to 15% shorts in it. And then, and I run a global allocation fund that is, an equity oriented 60-40, or sort of a multi-asset that allows me to do, some commodities, usually through ETFs generally. And it allows me to move around debt to equity. So anyway, those funds are awesome to run. They're a lot of fun because we can literally go anywhere. With obviously some targets and some parameters on the different ones, but yeah, they're fun. They're fun to run, and I'm pretty intense about, like you say, about research and analysis, and maniacal about trying to figure out, how you optimize return per unit of risk, and I'm crazy about data and to try and figure out how to do it effectively.
How did you figure out how to add equities into your mix? I mean, it's corporate credit trades somewhat like equities, particularly in times of stress, but because a lot of macro people struggle with equities. How did you get your head around equity risk?
Yeah, I mean, so a lot of it was, starting with this, we talked about earlier, being an entrepreneur, and then being in credit. And I really, really love, I mean, to me, this may not be an inspiring thing, but I mean, to me, like, I really like reading a corporate earnings report or a 10K or an annual report. Like, I don't know, like, my wife on vacation, she'll say, "What are you doing?" Like, working, you show me on vacation. It's like, I actually enjoy, like, if you hand me at big companies and like trying to figure out, like, how do they drive cash flow? Why are they spending this much on R&D? I don't know, it's a little bit like, it's a puzzle for me, and I like trying to figure it out. So it was pretty natural to move from credit to equities. Even when I was running credit, I used equities to hedge.
Right.
But, the one thing I will find about that, one man's opinion about doing equities for as long as I've been doing them now, it's a really interesting thing. I think most equity people that have a heritage of just in equities, they follow earnings, top line revenue growth, and they don't really look at the balance sheet. And so there's 3 ways companies can generate earnings. It's your top line revenue, it's your gearing and your margins. But gearing is a really, really big deal. And understand, like, how does the cash flow get down to the equity? Like, if you got a bunch of debt on along the way, you're not going to get the cash flow down to the equity. So anyway, I spend more time looking at gearing and the structure of the balance sheet and what drives cash flow than I think where most equity people are very much. No, by the way, it's nothing wrong about it, but most equity people like to follow, like, and pretty, if you're a tech company, it's a different gig. Like, how am I getting from here to there? But maybe a little bit of a different orientation. But I really like looking at companies. I mean, I think it's, and, as companies are changing and, at AI, it's fascinating.
And how do you think about the macro in terms of equities? Or are you all bottoms up, or is this within your macro framework?
Oh, it's a great question. So I've come to my personal opinion. I don't think top-down analysis works. One man's opinion, because I don't think, like, people say, well, labor is going to slow, and, this is why employment's going to slow. Like, the only reason I think that you can figure out, like, for example, when you get an employment report or a JOLTS report, like, what's happening in construction? Why are they hiring? Why are they not hired? Why are not hiring? What's driving the decision around CapEx? Like, are they spending on CapEx because of the growth dynamics, or is it maintenance CapEx? What's driving inventories? Why are companies running up or running down their inventories? What are they seeing? Like, I just don't think coming from the top and trying to figure that out works. I think you've got to build up. And so we use so much data, and I've been to read so many of these earnings reports. I really think I learned way more about what's happening in labor from just, understanding how companies are doing it. Those are who hire people. Like, for example, today, like healthcare. Like, why are people hiring in healthcare? And you could see it in terms of need that we've had for nurses, and we still haven't solved that deficit. But, by the way, look at some of these numbers coming out. Healthcare and education, not cyclical, not interest rate sensitive. Why do people keep hiring? Well, they keep hiring because there's a dearth of those people, and you need them you can't operate your top line revenue until you fulfill. And same thing with restaurants and hotels. But I just think trying to figure out that labor condition, from the top, using traditional economic models, and there's some geniuses at doing that. One man's opinion. I just think it's superfluous.
But then how do you spin your head the other side, which is you're trading fixed income, which is much more macro. So you're using two different sides of your brain at the same time, right? Your bottoms up credit and equity, and then top down fixed income.
So it all starts from the bottoms up. I mean, for me, it does because so today, so another good example today, like I think the interest rate tool that the Fed is using is completely blunt. I don't think it works. Because what happens is you have an economy that most big companies don't really borrow today. The companies that spend on CapEx and R&D don't really borrow. They're free cash flow rich, but then you look at the bottom end of the income strata that is really struggling, the borrowers, and you see this in credit card charge-offs, loan delinquencies, and you look at the credit card companies and you say, gosh, I see what's happening. Or you look at when Walmart reports or any of the retailers reports, like you can look at what's happening. Why you're seeing more couponing, more promotions, the lower end's getting hurt. Like, you take all that data and say, okay, now I got to now assimilate that. Why is the economy slowly moderating? It's slowly moderating because we're pressuring the heck out of low income, small business, local banks. And you see that manifest itself in all the numbers. So I always believe that you gotta understand the component parts. And, that drives. And part of why I think, I think people get so wrong weight on the Fed. Not that I get it right with others, but I think people get so wrong weight on the Fed is because they look at, quite frankly, surveys. Like, I think surveys are grossly distorted. Like, I think this industry spends way too much time reading surveys. People I think everybody reads the same stuff, and they all respond the same way. It's like the surveys don't tell you anything. I don't think, or I think they're incredibly distracting. Whereas I'd rather dig in and understand, like, what did they actually do versus what they're telling you they're going to do. You mean us better than me. Markets do what people have to do as opposed to what they want to do. And it's the same thing with companies. Like, if they don't want to hire more people, they'd rather keep their margins up. But if they have to, and so, I really believe that's what drives how you think about these things.
How about in the fixed income where, you guys are very big fixed income managers? What's changed to the structure of liquidity these days? Do you struggle to move stuff around? Because the structure of markets feels that it's changed significantly after Basel III and a bunch of other things.
I'd say the market's really episodic. Like, it tends to be markets go one way. And, I think it's led to the growth of a lot of momentum players because, whether that is not enough deep capital or what have you, or capital that's a frictional capital in the markets. But there are times when part of why, like, I don't like trading some markets, like, for example, inflation break evens in the tips market, not liquid. Everybody goes the same way at the same time. Like, I don't ever want to do it. So we tend to, when I move around my risk, I tend to do it in the deeper markets, rates, currencies, equity indices. And then, the way we try to look at it is, I always bucket my portfolios into four categories, one being the most liquid, where my transaction costs are pretty low, down to the fourth, which is like cement. And I'm never trading it. I bought it because I'm going to hold it for 5 years and I'm going to sit on it. And then you've got to scale it appropriately. But I trade a lot in the active liquid markets. I move my betas, my correlations around using the most liquid markets. I use a lot of the volatility markets. Like, I trade a ton of equity options because that market, you get some depth around convexity. And so, I know, but I think your point's well taken. It is definitely trickier at times. And, you think about some of the credit markets, like the high yield market. I think that market trades the same size it did 10 years ago. And other than the index, like to trade an individual name, it is brutal. So, it's part of why in some of the individual names, we own them, we're going to hold them, and then we trade the index to trade our beta around it. But the market is that way.
Yeah, it feels that, the demise of bank trading desks has killed a lot of liquidity that used to be there, because there were some big balance sheets that could move stuff around, and that seems to have gone. So it seems to be much more flows driven one way or the other.
Can I throw one addendum to that? I think that's right. And I think there's truth to that. However, I will say, I haven't been on the sell side for a long time. When I thought I should reduce myself, when I sell fast, I try and sell faster than anybody else and buy it. So I still feel like you had, no doubt, like you said, the pool of capital was different. I think there's been a democratization of information, though, that has made it this everybody traveling in the same circles at the same time, and I think that has been a really, really big driver of things over the last few years, that the information flow is all out there. And when people get it, they tend to react. And, for me, it's changed the nature of how you invest. Like, quite frankly, the only way to make money in most of these markets is you have to take the risk into the news, because after the news, the market has fully priced it. And so you got to take the risk into it and be willing to bear the consequences if you are right.
The other way that I found, for me, what really worked, I've been a macro guy my whole life, running a hedge fund, everything else, is I just entirely changed my time horizon. And I went super long term, and nobody's there, because everybody was down to managing 2-week P&Ls to have their monthly NAV reporting. And I found that really works. So how do you think about this balance between long-term risk-taking, short-term trading? And does that bucket move around a lot when you think you've got visibility? How do you think about it?
It's a great question. So part of why I bucket my assets into, so I think about it more stratified, that like the tier one stuff, I could trade a lot. I can move my duration around a lot. I can't move some of my individual credit exposure. I can't move my bespoke financing stuff for real estate or others. I can't move that at all. So I tend to stratify it. But, I would love to have the luxury in all my portfolios to have as much time and extend my time. And I just don't. So what I try and do is orient. Gosh, if I got, a lot of my funds are daily liquidity funds. I just got to run a big pool of liquidity. So what I end up doing is, if I think, for example, you're getting paid for illiquidity in assets today, I'll amp that up. But then I know on a multiple basis, I've got to amp up my, what I call tier one liquidity. I got to run a way more liquidity than I otherwise would. So I'm always thinking about, like, what are the levers that I have to pull around that? Having more time is always beneficial. But, there's a real, we run a lot of portfolios that people may change their opinion and they want to change it tomorrow. And so,
yeah, you've got super liquidity terms, so you have to match that and still drive long-term returns. It's not an easy. It's not an easy balance to take. Because
no. But quite frankly, it's part of why I like it the way it's structured. I really enjoy the dynamism of the news changes and try and figure out that news, and hopefully you've prepared in advance to think through it. And then, oftentimes a lot of the great returns are, talking about like right before the news, right before the payroll report. You gotta place your bets, as it were, do all your work, all the analysis you can, and then try and do it, and then react to quickly to what happens. So, there's some good returns if you get that right.
How do you think about risk?
So I have a different view than most around, and maybe that's going through 2008 or early in my career, taking a couple of big hits. I use this expression, make a little bit of money a lot of times, and some of it is a scale of what we run. But I really believe in this thesis that, we got big teams around the world. And so I've told a story before, I learned from we had an outside speaker at Wharton that came in and taught us about how they run casinos. And he said, "How do you think we make money in casinos?" And I raised my hand, "The odds are in your favor. And I've studied this." And, he said, "Actually, only moderately." He said people come in, they bring $200. This is earlier. They bring $200, and when they lose the 200, they leave. And he said, you think about how markets oscillate. And he said they go up and they go down. They were thinking about how people gambling, they oscillate, and they're always going to hit the down 200 at some point, and then they leave. Well, I've always thought about that. I always thought, like, I don't want to hit the down 200. And so I always thought about, like, gosh, it's a better business to be at the casino than the person who's doing that. So I've always thought, like, if we use really good research and analytics and portfolio construction tools, if we can tilt the odds in our favor, just do it a billion times. And so my thesis has been just, keep making a lot of decisions. And I've tracked this over time. Like in credit markets, less liquid markets, we can usually get it right 70 to 75% of the time, hopefully. And then in more liquid markets, 60. Just instead of like blowing my year up because, gosh, I think everybody's wrong on the Fed. Those markets tend to be pretty efficient. I'd rather make a billion decisions. And so, I really run this business of trying to be tactical, make a lot of decisions, let your teams, let the odds work for you, and then do it a billion times. And I just think that creates what I call durable alpha. We still go through some painful periods, but tend not to hit the down 200 if you're running it that way.
When you and I were chatting over dinner, we were talking about AI. How are you implementing AI in your process now?
So I'm spending way too many hours trying to figure it out because it's arguably the biggest technology innovation, certainly since the internet, but maybe the biggest thing we've ever seen. So there are a bunch of different ways we're going. First of all, I'm convinced he or she who has the data is going to win. And, so companies that are, and I think part of why you're seeing this with big business versus small business, you're seeing this moat growing is the companies that have the data. You look at some of the big tech companies that have the data and this acquiring all the data, I think those companies win and they'll build their moat. And so people say, gosh, look at the Russell versus the big, like, I don't know, like small cap's a hard thing today because if you have the data. So that's one. Two, trying to figure out the energy implementation like everybody and think about all the parts around. The amount of capital that's got to go in. Nobody's ever seen anything, and I just don't think there is enough capital and there's enough grid to. So anyway, we're obviously in the energy space. We think there's some really interesting things to do, both in debt and equity, to finance it as well. And then trying to get into the businesses that are secondary, or tertiary, impacted, that are how we're trying to navigate it. And quite frankly, like every day, including yesterday, I'm meeting people that are in the industry that have an interesting way to do it, private versus public. It requires a ton of capital.
Yeah.
And so we're trying to be thoughtful about where we're putting the capital.
And what about internally in your process? Are you using AI to filter, to kind of put Rick in a box, as Paul Tudor Jones used to try and build his Paul in the box idea? But, you've got this bottoms up process of analyzing all the balance sheets. Obviously, you enjoy doing it, but AI can do it pretty quickly and efficiently.
So I had this honor of, I did a one-on-one interview with Sam Altman, and I thought, by the way, I realized how intellectually intimidated I could be. Anyway, he said something I thought was incredible. He said, augmentation will happen much faster than people think, and automation will happen slower than people think. And I've been thinking a lot about that. The way we're trying to exploit the opportunity is, like, how do you use data to, data assimilation? How do we get our information faster? How do home builders are doing this? Like, let's get the information quickly. What is it regionally? What's happening? That's been huge for us. And then obviously you get all the data, interpret it. Augmentation happens if you can interpret it faster and more efficiently. That I think is really big. Second, I think portfolio construction. Like we'd spent a ton of time trying to understand stress testing, scenario analysis. You add an asset to your portfolio, it contributes risk and return potential. How does it play in that sandbox with the other assets? Because it's got all sorts of different characteristics. Well, AI, when you get this, you think about all the planes of when you build a big portfolio, what is every asset doing? AI, tech, and obviously compute allow us to do that more and more efficiently. So we've been spending a ton of time with it and trying to figure it out. And then, and by the way, one thing that I've learned more recently, it's actually what questions to ask.
Yeah.
It's like, That's been a bit of a
Oh,
revelation.
it's hard to, you got to get your mind around how to ask it.
And I think some of the we're working with a group that's helping us do that. That it's not just that it gives you the information, but it's actually what is it? Are you asking the right questions? And that has really been fascinating to me. That maybe we're interpreting something in a way that we should think about it differently. That's been pretty powerful.
You know, what shocked me is I've started putting economic stuff into GPT by giving it charts and asking it to give some sort of forward analysis or analysis of where we are. It's not bad. I give it technical analysis charts with like demark analysis or whatever it is on it. And it kind of can read the charts really well. I'm like, this is very disruptive. I don't want to see this, because I'm an analyst as well. And I'm just thinking, bloody hell, this thing is moving really fast.
Yeah.
In the value it could add, the augmentation idea to people in this industry is huge.
It is. I keep saying to my team, I find like with any new technology, and I've learned over the years that with entrepreneurs, usually the idea they started with is not what they end with. And it's pretty incredible how people tend to fail first. And it's almost like a badge of honor in tech if you fail, like, look at this. And but it's because you learn and you go in a different direction. Whereas in finance, you try not to fail. But it's pretty interesting. And I think it's a very similar thing here in terms of how you think about that evolution. And I don't know, it's pretty extraordinary about. And so what I asked my team and what we've been working on is like we're going to throw a lot of stuff against the wall, and we're going to try this. And is this working? How does that work? Because whenever you're in the I call it operating in the haze. Like, I found this over the years, but like I find you can't make a lot of money on a trade or an investment until you're operating in the haze. Like if it was obvious, like there's no money in that.
No.
Like you have to operate like in the haze. And I feel like in AI today, we're operating in that haze. And, we got to look at this and check that out and see if this is durable and what have you. And I feel like we're right in the middle of that now.
Here's another question I want to ask you, because something I've been thinking through. I think since 2000, there's been a structural shift away from credit as the main financing vehicle for new businesses to equity. Almost nobody can borrow money anymore to start a business. I mean, try going into the bank saying, hey, I've got this idea to start a software business. They'll show you out the door and think you're a madman. But everything is raised by equity, which changes the kind of risk profile, as you were talking about, because these startups now, they lose equity, but there's no debt. So there's no other obligations attached to it.
I also think that it means, most new businesses bleed cash early in their life, in their life. And because like you say, if you had a cushion of debt alongside you, you have more time. You don't have time now. If you're going to blow through your equity quickly, it's game over. So I think when, we look at a lot of these investments and we think about, we got to put equity in, or we are putting equity in. You really got to think about, do they have contractual revenue on the other side? What's their contingent liquidity? How are they paying staff? Like, can you stumble, you got to pay your staff. And when do they become frustrated and leave? So it's a very, very different. There's no cushion that like you used to have. It is, and by the way, it usually also means that the equity, that the reward for getting it right is better. It's often is better because, you're getting the equity at a more appropriate price.
Do you think the IPO markets ever recover? Or do you think it is now a privates-driven market where it either goes into PE hands or it just goes into one of the big tech companies or whoever the acquirer is? Do you think the structure of markets has changed?
Wow, I don't know. I got to think about that. That's a great question. I don't know. I got to think about that. I think the nature of, you think about what drove in the SPAC market, I think some of that is, probably put to rest for a long time. But I think durable business models will come to the market. It's a really good question because I keep thinking about this idea around time. Like in the private markets, the benefit of private markets, they give you more time.
Yeah.
And, there's a closer interplay with who your sponsors are versus, the public markets. Public markets need to see recognition quickly.
They're brutal.
And brutal. And, I know a lot of CEOs, quite frankly, don't like the quarterly reporting and so, operating in a private can be much more helpful to thinking through your vision and managing your vision. So my sense is the IPO market is cyclical, but I agree. But I think there's some reasons that at least for the foreseeable future, it's probably not going to be what we saw over the last few years.
And how much you do privates as well, right?
There, yeah.
How's that shifted as a percentage? My guess is it's probably gone up for the same reason.
So, we're in this is nirvana in terms of I get while the money's coming into private credit, and I can't run obviously all private credit, but depending on the fund, I could do 5 to 20% less liquid assets or illiquid assets of privates. And, to exactly what you said, I've never seen the environment today, particularly in commercial real estate. Like nobody wants to touch commercial real estate because office is imploded. But boy, there's some interesting things to do in hospitality, multifamily, logistics. So the terms you're getting today for that reason, in terms of cash flow sweeps, parent company guarantees, covenants, structural benefits, warrants attached, that are pretty neat. And so it's a pretty good time to be a lender in the private credit, not just credit in the true form, but real estate, et cetera. So it's a good time to do it. So yeah, to your point, I've been moving more to that. And then what I got to do on the other side is I got to run more liquidity. Yeah. But what's neat about today is because the risk-free rate is so high and spreads are tight in the public markets, it's like I can run a lot of really liquid assets because the risk-free rates get me so much yield. And even buying things like agency mortgages, like you're getting so much yield from agency mortgages or investment grade credit, then I could use my what are normally less liquid assets that are like EM or high yield, like lower quality high yield. How much do I need of that stuff? I'm not getting that much incremental yield, so I can run much more of a barbell and run, own some privates with some liquid paper and keep a lot of, keep your yield and your liquidity in good shape.
Do you invest on the privates on the equity side as well? Direct investment.
Yep, I do, and that is evolved. I would say the last couple of years, some of the stuff we've done we don't really do venture, but sort of the second stage, third stage stuff has been challenging to say the least. But now there's some really, really good opportunities that are coming. And so we do it. It tends to be, for my business, it tends to be a smaller portion of what we do. But anyway, I did the same thing as we talked about earlier. It's a lot of fun to try and understand business models and the potential around these business models. And then, it's interesting, and exactly the point you said before, some of these business models, I think, are really good business models because they can't get the cash today, are going to go, which is a bad state of affairs, are going away.
I know, and what you're so lucky with, because you're forced to run such a big liquid side. When nobody's got cash to do the direct investments, you get the best deals because you've got liquidity just by structure of how you operate.
Yeah, and by the way, it's a relevant point to what you said before. Scale matters today too. If you can provide, we've had a number of situations where somebody says, "Listen, if you can provide the financing, and I have certainty of financing, that's a really big deal, and they're willing to give you a lot of structural benefit for doing that because you functionally de-risk their enterprise." And so, we try, not just in my fund, obviously we try in my funds, and other funds across our firm. If we can use real scale, there's a benefit. There's a benefit to that. So particularly today, where like you said, financing can be difficult.
Well, because there's been no IPOs, so all of these private equity guys are all stuck and they can't release any capital. So the whole market's not doing well. People like yourself, it's a good environment. So what gets you excited going forward? What are you looking at outside of, let's break it down to two things. Let's talk about the rates market.
Yeah.
Your general view on interest rates over time?
I think they're coming. I think they're structurally higher because of all this massive spend we talked about in AI, infrastructure, climate, and the U.S. government has too much debt, way too much debt. And so I think the amount of funding they have to do. So I think interest rates stay structurally higher. That being said, I think the Fed is going to cut rates. And I think they want to, and I think they have to because of the pressure they're putting on low income that we talked about. So I think they will. And I think, their mandate is price stability. Everybody thinks the Fed's mandate or the ECB's mandate is two. It's not two, it's price stability. As long as you're close to the pin and the economy is operating. So I think they'll bring rate down. So I think rates will come down.
If they don't, how do they finance the rollover of the debt? Right, because that's the other issue here. Is there's the elephant in the room is Janet's got a very big job to do, is to try and refinance all this debt.
They can't. And I think the biggest risk in the next couple of years, the debt's too darn big. And I think we've seen the most immense movement of leverage from the private sector to the public sector. And it used to be, I was on the Treasury Borrowing Committee and for a number of years. U.S. Treasury loves using Treasury bills because you manage the tax receipts of the country effectively. You toggle up and down bills. But we used to issue bills at 0 to 1%. We're issuing them at 5 and change, $400 billion a week. It's too big. And it is. So I worry about part of why I think the Fed has to get the rate down is we don't have as many buyers internationally as we used to have. China used to be a buyer. Japan was a bigger buyer, et cetera. Banks used to buy. Fed used to buy. We don't have the buyers. And B, the debt service in this country is going to eclipse our military spend, and we'll have no fiscal. The mandatory spend doesn't seem to move because we can't make good decisions on mandatory spend. So, listen, have you said to me what's the biggest risk in the next couple of years? That's it. Like it's the debt's too big.
How I see it is every central bank and government is now basically using liquidity, so they're basing currency to pay for the debts. We kind of see it at every level. We've seen the game between the Treasury General Account, the reverse repo, and QT, and like they're pretending they're doing QT, but in fact they're injecting liquidity into the system. It feels like that's the game. I mean, the Japanese have done it for a long time. The Europeans have done it. And pretty much everybody's doing it.
So, think about it. At some point, I don't think it's going to blow up in 2024. And if the Fed is reducing rates and people feel good about, the rates will stay stable, this is a tremendous amount of income you garner, particularly if inflation is down, your real rate of interest as an investor is really good. But I think over the next 2 or 3 years, there's going to be a point in time where the Fed will have to hike rates or, rates for whatever reason are going higher. People would say, I don't want to own it. Fed's going to have to put it on their balance sheet. Fed put, you have this very similar paradigm to as you described in Japan. We were watching real time play out around the currency. The U.S. is a reserve currency in the world. That is, and the benefits you get from that are immense. I think it's a really dangerous thing. And I think policy, I've said it before, and I've said it to a lot of policymakers, I think we need to address it. And I'm just not sure nobody's going to run for election and win on let's cut the debt in this country. So I think we're going down a dangerous path.
Not with an aging population. I use the chart of the labour force participation rate, and against it, look at government debt to GDP, inverted. They're actually the same chart. So as the population ages out, the government debt goes up. I don't see a way around this. So I just think of the 1950s, and it's like yield curve control is, Japan. Japan have led the way on all of this.
So there's only one way out, and I really believe this. And nominal GDP has to eclipse your costs of the debt. So the only way you get there is you have to bring down the cost of the debt, which I think the Fed's got to do, and I think we'll engineer that. But B, you have to find a way with a demographic. The U.S. demographic is aging, thankfully not as bad as Japan was or Europe is, but it is, to your point, the fertility rate is not fast enough. The other benefit, when it gets in a super controversial area, but immigration has actually helped expand nominal GDP tremendously. What we do with immigration, I'm not a big fan of illegal immigration, but we have to have immigration because, like you say, otherwise you can't grow nominal GDP fast enough to offset the cost of the debt. And then, because the U.S. has this extraordinary ability to innovate in technology, if you can do things, there are initiatives like R&D tax credits, accelerated depreciation in areas like chip development, like clean energy, that if you create enough fiscal programs that have velocity to them versus just helicopter money, keep nominal GDP up, allow appropriate immigration, and then keep the cost of the debt down. But it's hard. You got to have both have to happen.
My view on this is that, if we think of trend rate of GDP is population growth plus productivity growth plus debt growth, let's say. Debt growth's pretty much broken now. So we've got population growth is falling, negative in many places. But even the US, you said the births, deaths is falling. Productivity, because it's an aging population, has gone down. So I see the battle on two fronts here. I see Europe saying, we are just going to throw stupid amounts of money at lowering the cost of electricity. And it won't be wasted capital. If we can do that, if you can get the cost of electricity from price 100 down to price 25, it's a 3x multiplier on GDP. So that's one. And the other thing is, I just think that the population problem gets solved by AI and robots. They're infinite people. In the end, we've got to get bits from here to there first.
Well, that's your productivity argument. And I mean that if you got some exogenous productivity enhancement, which I think you could, like that is a really big deal. And you think about what that does, that brings down your costs, should bring down your cost of debt because you brought down your inflation significantly. That is totally agree. By the way, part of why wouldn't you, if that's right, which I think it is, why wouldn't you actually, if you're the government, why wouldn't you put money towards making sure you are globally competitive at that, and you are running the most efficient forms of that energy, investment in energy, which is required, investment in chip development, et cetera. But yeah, completely agree.
I mean, nuclear has got to be one of the big answers here, but
I agree.
Politics is slower. It was interesting. I was with a big family office from Italy, and they were speaking to the government. It seems that in the background, most of the European governments are starting to understand that they can't do it without nuclear. Solar's great, but it just doesn't scale because of the storage enough.
It's pretty amazing. Europe and France and Germany and other places that how the needle has swung.
Amazing.
And I agree with you. And, I think solar and wind hydro are also incredibly powerful. They're just really hard to scale. At this point, they're really hard to scale the size you need it.
That's right. So what's the one final thing that you're most excited about in the investment world? Can be any time horizon. I don't mind. I won't impose that on you. But what do you think? This just looks like people aren't seeing this. It's in the haze, but I like it.
So first of all, the AI thing is pretty cool. So, but since that is, people talk about it, we talked about it, I got to leave that aside. That's pretty cool. I'd say two other things that I find really interesting today. One is there's a massive cultural shift towards experiences versus goods. And I think that is an amazing evolution. And you look at that in prices for things for goods that have come down, and you look at, what people are spending on travel, restaurants. And by the way, I think it's a pretty cool thing. And I think it's a good thing. So from an investment point of view, I'm just trying to get in. I mean, what people are paying for Taylor Swift tickets is truly incredible, but it's a microcosm of what people will pay for a good experience and being together. So I think that's
the more digital we are, the more digital we are, the more we value those experiences.
I agree.
Here in the Cayman Islands, in 2020, Christmas 2022 was a pretty bad time for the economy.
Yeah.
Record tourist season.
Totally.
Because people were bringing their whole families with them because they wanted to get together. And I've observed the same thing. The whole experiences economy is gigantic because we do so much of this Zoom stuff.
Totally agree. And I think, by the way, COVID put that into high gear. And I'd say the last thing that, because I've been around fixed income level my whole career, like this creating, it's torture when rates are at zero or the dumbest invention in history, negative interest rates, where like, oh, I got to buy high yield because I can get 2.5 for it. Like that stinks. Like today, you can build these portfolios, 6.5, 7 portfolios, sleep at night, marry them to your beta, your private equity, your private debt. Like that's pretty cool. Like today, I'm pretty energized by like 7 is better than 2. And how
long does it last? Or do you try and lock in as much as you can now for the longest period of time?
I think it's got some legs to it because of, the Fed's going to take time. The ECB is going to move faster, but they'll take time. But I think it has some legs to it. But that being said, I tell clients all the time, like, buying, you don't have to buy 30-year paper, you don't have to buy 10-year paper. It's not worth it. But, buy 3 to 5 year stuff, just put it away. And then, and boy, it's a pretty good environment. I think exactly what you were describing. We have to reduce the cost of debt. There's so many reasons it has to come down. Hopefully through productivity and lower inflation, it gets there. But if that's right, and the Fed will have to get it there, getting some of this yield on now makes some sense. And it's a neat thing to be able to get income at these levels.
And also, I love the idea that you had is that essentially you can make use of that yield and you can put it into risk capital.
Totally.
Which you couldn't do before. You didn't have that.
No. And you know this better than me. So you always think about your buckets of risk. And if you said, gosh, I now can take my yielding bucket and I'm not using a lot of risk for it, it just allows me to use that bucket of risk for other things that have more convexity to the upside. And that's a pretty good investment environment. Not without some volatility to it and some downside, but that's a pretty good investment environment.
Exactly right. Rick, listen, fantastic conversation. I really enjoyed it.
Oh, it's great. I appreciate it.
Yeah, and we'll get you back another stage and we'll chew through what's going on then. But let's see how this all plays out. I'm with you. I think the Fed are forced to cut, regardless of any other narratives. They just have to bring the costs down. They can't refinance this.
No, there's no way. There's no way. There's no way. Think about it. If you're trying to raise debt to raise the cost of the debt to deal with inflation, you're going to simultaneously reduce nominal GDP and bring your cost of the government up. It's like it doesn't work. It's going fully backwards.
Yeah, somehow we've got to get GDP up. All right, my friend. Great to see you. I really appreciate your time.
Thanks for having me. I appreciate it.
All right. Take care. Really interesting conversation with Rick. How different we kind of approach some things. His time horizon is different. He's much more aggressive trader in some respects, but he's also very risk averse in other ways. He really is a very thoughtful person to speak to. He sees the very big picture down to what happens on the employment numbers. That kind of level is quite something. And some of the very best macro investors can think of all of those multiple time horizons. I tend to be longer term, as you know. I find it easier. It gives me an informational edge. But if you're as good as Rick, you can get down to short-term time horizons too. And now you can understand why Rick has been so successful and manages so much of other people's money. He really, really has learnt the lessons on his journey and really understands how to implement his strategies. Anyway, see you next time on The Journeyman. Now, don't forget, please sign up to the channel here, the YouTube channel. If you've not done so, just click on the button below. It helps me tremendously. Also, check out realvision.com. It's free. It'll help you unfuck your future. It's really important. There's all of the knowledge, tools, and network to help you succeed. Within that, if you remember at the beginning of the video, I talked about the macro investing tool. That's an add-on that will really help your macro game. So make sure you check that one out. It's in the Real Vision marketplace. And if you're a Real Vision Plus subscriber, you'll get the whole Real Vision Academy, including how to build portfolios, how to research ideas, how to manage risk, all the things that matter to be a great macro investor. See you next time.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.